All right. Hi, it's Dre Griggs with Obsidian Wisdom. I am thankful for our time together. We're going to have another Retirement Readiness Thursdays. Today, we're going to focus on if you're an entrepreneur. And so, retirement planning when you're an entrepreneur, it is a little bit different than the retirement planning that you normally engage in when you have a career and you're working and you pay your 401k or your 403b if you work with a nonprofit or something like that. There are additional opportunities that are available for entrepreneurs. Now, the reason that this is important is sometimes we don't always think of ourselves as an entrepreneur. So let's start by just defining what that looks like. First and foremost, if you have anything that is outside of W 2 income, so if you have 1099 income, so that could be you working in a gig economy, that could be kind of side jobs. You technically, it could be any time that you contract your services out as a consultant. And yes, it could be you with a business. It could be you as a attorney or a plumber or something like that. Interesting enough, there are lots of people who are retiring, and when they retire, they start a business. Or sometimes we retire from a career, as such as myself, and then we start a company. And then once we receive this income, it could be inheritances, it could be settlements. What do I do with the money? And that's what we're going to focus on today. And so, in this particular case study that we're going to go through, I'm going to share it with you. This was one of those where we're going to figure out, hey, how do we go from having a 16% chance of probability of success to a 96%? And one of the cool things that you're going to notice is you have more options when you are in a business. So, for example, when we talk about things like an individual 401k, that's the strategy that we use. You may also hear it referred to as a solo 401k, a solo K. It's this idea that we know if you like look it up, it says, hey, I'm allowed to contribute up to $70,000 into this 401k account. But then when you read further down, it says that the limit for an employee is 23,000. I believe it's 23,500 in 2025. So then we're sitting there like, okay, it says I can contribute up to 70,000, but then it says I'm limited to 23,500. So where does the rest of that contribution come from? And that's really where your employer is able to let you take advantage of this. So your employer contributes the rest of it. Sometimes in your normal 401k, you may have a company match. So if you have a company match, then that portion goes in over whatever you contribute, that 23,500, to help you get to that 70,000. We also have opportunities where there's other profit sharing measures that our employer is able to take advantage of. Now, there is the extreme cases, which we don't normally take advantage of, but I'll give you at least one time where that makes sense. And that is where we contribute knowing that the money's not going in tax deductible pre-tax, that we're just putting in after tax income. And that's normally going to be if we plan on rolling the amount over at sometime in the near future, like literally tomorrow. We put the money in today and we plan on rolling it over as the backdoor Roth tomorrow. And so when you're an entrepreneur, you have this ability to access what's called a solo 401k as long as it's just you and your spouse or a business partner. Those are the only people that are allowed to work at your company. And if that's the case, you have this plan and I'll be able to show it to you. So, well, first we'll start with just going over the case study, right? So you can see here that we had about $140,000 in a bank account. We had our regular checking, our savings, and then we had the second account for the business, and there was nothing that we put there. And then we have our credit cards are about 19,000. We have investments where we just had an investable account because this person was a business owner. They didn't believe that they had the ability to contribute to any pre-tax investments of any kind. They also had the ability to take advantage of a Roth, and we'll go through that as well. But they were just putting the money, which is great. A lot of the times, there's two things that I find a lot of business owners do. One is we invest back in the business because we're like, hey, you know what? I'm able to get a great return from my business. I know this industry, this job, this experience. I know it inside and out. I'm able to get a 50% return on my money. So I have a client that's very common with real estate. So if you're in real estate, oftentimes in your mind, you're like, well, I'm in the industry. I know how to flip a house. I have so many things I can do. I would rather reinvest the money into a new property than necessarily putting it away for retirement, which is totally fine. And there's ways that we can coordinate it together. But the question often becomes, where does the money come from when we're done working? And we may have rental properties that generate the income. But oftentimes we have to have something that is creating money for us when we're not working. And so when you're looking at that, most of the time there's three asset classes that we invest in. And business owners, you're no exception. That's normally going to be a business, which is particularly what's going on in most of these cases. It's going to be the real estate market, which sometimes overlaps with your business, or it's going to be the stock market. And there are seven streams of income the IRS says they recognize, and six of them are what we would call passive income. I don't mean it in the sense that you just kick your feet up and don't worry about it, but I do mean in the sense that it's not tied to your time forever. That you may spend, like, let's say I put an investment portfolio together. I may spend a week putting together your portfolio, everything from your risk tolerance to the market and investigating and analyzing different numbers. And then I put the plan together. Obviously, that doesn't count the many years of experience that I've built over the time to be able to do it in a week. So is it passive? Sure. But I had to put the work in ahead of time. Think of it like a book if you're selling that, things like that. So we'll go into some of these other options, but 65% of self-made millionaires have at least three streams of income. And that's the way the numbers normally work out. And that's what I encourage most people to do. As far as the loans, we have a business loan. They have 25,000 left on that. They have their automobile, another 25,000. Then they have their mortgage at 480,000. The property is currently sitting at 750,000. As far as the goals, and you guys know I'm a goal-based planner, I do believe that goals are very important because it allows us to have that thing to compare the spending against. And what I'm saying is a lot of the time what we'll see is if someone is spending excessively in the present, where it's very hard for them to see the future, in my general experience, I believe it's because they haven't planned the future. So you have two choices, right? You're sitting there and you're saying, okay, I can either spend the money on, let's say, a car or a trip today, or what, right? And a lot of people, we don't have an or what, which is why I believe or, and then we insert the goal, then it changes things. And you really can look no further than when you see someone that ends up maybe getting diagnosed with something, like maybe they get diagnosed with cancer and then they change their eating habits, or they have a heart attack and then they change their health because now they have something to compare it against. At the first, it was like, well, I'm eating, what's the big deal? No one's going to live forever, yada, yada. And then when something happens, we're like, well, wait a minute. Now I have something to compare this against. I want to be there when my kids graduate from high school. I want to go to their wedding. I want to be able to enjoy my retirement. So we have something to compare it against where it makes it easier to say no in the short term, to say yes in the long term. And so when you look at the goals that we have set, right, we want to retire at 65. We have the retirement expenses where it's going to be about 4,000 a month is what we're estimating. Healthcare expenses, we keep and we could always change it, but I keep normally the national average because that's just kind of, I mean, it's the national average, especially if you're going to move and different things like that. They plan on traveling. They want to travel around the world. So we're talking about internationally traveling. We're probably talking about one trip, sometimes two every year. And then we'll say, all right, we looked at the numbers and that was about 10,000 in the manner they wanted to live, which is very important. You technically, and I remember when I was at Florida State, my sociology professor, he had traveled in so many places. And he said, the interesting thing is, if you're willing to live like the locals, you can travel almost anywhere. He's like, but if you want to live like the Americans, they're like, well, then that's a little bit more difficult. And so this particular situation, we don't want to live like the locals. And so we have the 10,000, and then we also have just general inflation. So it keeps track of what those numbers. This is the amount every year, whether that's one trip, two trips, or three trips. That's what we're estimating. They have a new car that they want to get, a little fancy light. And so that'll be 40,000. Charitable giving, they have a couple causes that they are very passionate about. They want to be able to support them. So that was 4,000. And then the golf membership. That particular country club was $15,000 a year. So that is what our plan is, and far as when we want to do these things. And always when you're looking at the numbers, we're saying, what is that? So it's every single year. And then when does it end? We're going to say he's going to be done golfing at 80. We technically could have the plan where it's when the person retires, which doesn't really work with golfing, or it could be at the end of the plan. So it's just when we pass, whatever number we put at the end. And so we put all those numbers in there. We assign a value. Sometimes I really like the idea of even adding goals that have no, financial cost, but it's just simply the goals. That's like, hey, when we meet, are we on track? Yay or nay? And it's like, well, yes, but maybe I could have did better. And then we look at the goals. What are we sacrificing to be able to do what we're doing now? And I love reading professional athletes and the best, and they talk about the sacrifice. And at the end of the day, we really have to understand, what do we want? How badly we want it, and what price are we willing to pay? And I was reading an article with Simone Biles, and she was talking about the idea of going in the next Olympics. And she was saying, I'm not sure that I'm going to go in the next Olympics because I know what it costs to be a gold medalist. And then she started listing the cost. She was I didn't get to go to prom, or I didn't get to go to college. I didn't get to spend a lot of time with friends. And she's like, now I'm married and I know what the cost will be, like time with my husband, possibly starting a family. And so she was telling you, I don't know if I want to pay that cost. And there's so much clarity when you see people who train and they're the best at their craft. There's so much clarity in what the cost is that they know they're paying on a regular basis. And I like to bring that clarity into financial planning. What is the cost? And are we okay paying that cost? Like, how badly do we want these goals? Are these wishes? Or are we really, this is like your dream life? This is what will bring a smile to your face every single morning. And so for this particular case, we started with these, and then we'll add them on. I'm big on adding on goals. We often talk about the beginning of happiness, and we measure everything in like 8 aspects of our life. Everything from relationships with friends, romance, support as far as financially. We talk about family, fulfillment, spirituality, health. We talk about a little bit of everything. And when we check off each of these boxes in the wheel, I find that if you spend your time on these things, you feel pretty good. So then when you move on, we'll go into the income. So in the business, we generate about $150,000 a year, and all the income is from the business. Our savings, currently we save about $10,000 every year in taxable accounts. And then the health savings account, we're putting in $3,650. I added the solo 401k and the Roth solo 401k because that's where I'm going to adjust the plan so that we can achieve the goal. Because oftentimes what we see is we're like, hey, I'm contributing a certain amount, I have a good bit of time. So in this particular case, we're 49 years old. So we're like, hey, I'm 50. I don't plan on retiring for 15 years. I already have $150,000 set aside. But it really comes down to what our retirement goals and what our life looks like. And so when we look at the numbers, we always start with the balance sheet. So we have a net worth of about $600,000. We take all of the assets, we minus all the liabilities, and then that's what our net worth is. We can see that we have that when we talk about 96% probability of success. What are we saying? We're saying that median number. So there's a 5% chance that we could have $395,000 or 22 million. And we're basically saying that if everything goes badly, we'll still have some money, which is a pretty good plan. And we're talking about 90 years old. And then if everything goes gangbusters, we'd have 22 million, which is probably unlikely to happen too. That's why it's 5%. And then you see that there's that middle median number is about 4 million to 11 million. And then we have the median, which is about 7.5 million, 7.6 million. That's where we get that number from. So we have a relatively good confidence in that happening. Their current allocation was a traditional 60-40. As far as the risk, it was pretty standard. And the way that the numbers worked out, we could actually be a little bit more conservative and still achieve their goals. Because you guys know, I'm normally saying, hey, you want to get around 80% probability of success. And I'll show you why when we go over the stress testing again. All the money is in the taxable account because they weren't aware of any way to put money in a tax-free or a tax-deferred account. So we're going to change that around for them. And then they do have the money that is being saved. And we'll go over the plan as well. So when you look at the stress test, so we'll start there. We always like to start there because it just measures our probability of success. And you can see that we have our 96%, that's the baseline. And then even if the market drops 20% at the beginning of the retirement, which you and I would probably be like, I don't want that to happen. I don't know. But it's still a 95% probability of success. And then you can see we're still at 92%, even if taxes are increased. For those that don't know, this is what we're measuring. So when we say taxes are increased, we're saying taxes are higher by 20%. I still have over 90% chance of success. When we say Social Security was reduced by 20%, which is not crazy, it's pretty closer to 30% if we continue on the path that we're on. And then that'll be 94% probability of success. Longevity, I live 5 years longer, so we're talking about being to 95. Still will be fine with my money. Inflation is at 86%, so we're just saying it's just 1% higher every year, which you can see in different plans. That's actually a pretty large number. Healthcare, we still 95%, and we're saying healthcare costs are 20% higher. And then asset returns, I get a 1% less return. And you see that one is actually on the larger end of the impacts. It dropped just to 91%, but still in a great situation as far as stress testing, different environments to build the confidence in the plan that we have. From there, we will, and I mentioned to you, we look at the investment, so we kept it the same for them. Let's go to the retirement plan, and I'll explain to you how we're able to achieve that overall goal. So you can see what we did is we ended up reducing what they put in the taxable account. So they were putting in 10,000, and we said, we can cut that in half. But we do need to start having your business help pay for your retirement, which is an idea that I think most of us would agree about. If my business is generating a certain amount of money, and we know that your normal employers can contribute to your retirement, but with a match and different things, and they get tax breaks for doing that. Why can't you do that with your own business, your own profits from your business income? And so if the business is generating 150,000, we said, hey, how about we contribute 30,000 from the business profits, and then $10,000 you would put into your Roth. And there are some cases where you can have your business contribute to your Roth, but it's just so messy. I don't know many times in situations that would work for you. Really, if you're thinking about it, if your business is going to contribute to your Roth, and then it's going to write it off, and then you haven't paid taxes on it, but you want tax-free income later, right? You can see why Uncle Sam is like, well, wait a minute, you put the money in, got a deduction, no one's paid taxes on it now technically, and then you want to take it out tax-free. For the most part, it makes sense for just you to contribute to the Roth Solo 401k. That was in the last bill that was passed. I forget the exact name of it. There's so many of them. I think it was the Tax Cuts Job Act. And that was one where the Solo 401k had the option of adding a Roth component because that wasn't there before that. So now you can go past with those contribution limits on normal 401 or normal Roth. And now you also can contribute more. You can still contribute up to that 23,500 in between the normal 401k. You can now put that in your Roth 401k versus the 8,000 in the normal Roth. So that's a really good situation for most people, because if my business is generating the money, if I'm in real estate or I'm an attorney and I get a percentage of the case that I close, and so I don't get money on a regular basis, but when I get it, it's a lot. You can then contribute this money to your retirement plan from the business. And then Uncle Sam will let you write things off on the business end, and then you get to grow tax-free money for your retirement. Everything kind of works together in a very effective way. And I'll show you even what that looks like. Now, it's important to know that when we look at, I was telling you asset allocation, if we change it to growth, let me show you what growth normally is. So we change it to growth. We're normally saying about 70% is allocated towards equities, and we're saying 30% is conservative, which would normally be inside of bonds. Then we talk about where we would have to sell the assets to achieve that. If we're allocated towards growth, we still achieve the goal. But what you'll notice is you see that 96% was allocated towards growth. If I change it to moderate, you see that we still achieve the goal. Yes, we have about $1 million less than what we had before, but we still have a 96% probability of success. And if we don't have any kids and we have a different situation set up, then it's like we don't have to go for the fences. We don't have to try to hit a home run if we can achieve our goal. And even the balanced approach would work for this particular situation. We can see we still have a 95% probability of success. Yes, now we're down to 4.5 million, but now we have more of our money that we're basically locking in the wins, that we're not leaving it out there to where it possibly could lose money if something crazy happens. So normally balances a 50-50, and then you can see where we would adjust this. And we would then be leaving the equities market, leaving real estate, and moving into cash and bonds. So that would be the major shift that we would be doing. And so we can see that even though we're not going for home runs anymore, we're still achieving what the goal is, which is why goal-based planning is such a better and effective way than, at least in my opinion, than just going for the dollar amount. Because if we're going for the dollar amount, what are we doing with it anyways? And sometimes if we go for the dollar amount, we sacrifice the things that matter to us, the things that we would technically buy with our money. So for example, if I'm sitting here and you're like, hey, I want to grind, I want to do this, I want to do that, and then we sacrifice our health, for a lot of people, the first thing that you're going to buy back when you have the money is your health, right? You're like, okay, I sacrificed my health, so now I'm going to get a personal trainer and a chef, and I'm going to try to buy back my health. What if we're able to put a plan together where you keep your health and you accomplish the goal? And that's kind of the way that I look at planning. And so for this particular one, though, I mean, at 49 and with their risk tolerance, it was A-okay for us to maintain the moderate that they had. And so that's basically why we made that decision ultimately. But we did have the option to adjust it. And then at the end, what I'll do is I will show you. Actually, let me just show you right now. I do think I have that pen with me, and I'll show you basically how a basically how a solo 401k works. So let me see if I can get this to work. Yeah, I can get that to work, and then we'll go from there. Let me share this whiteboard. Let me make sure that it went through. Yeah, as you can see, I told you I was going to get the whiteboard this week, and it ended up working. So let's talk about it. So right now, you have the ability inside of a 401k. Let me slide this down. Inside of a 401k, you have the current ability to put $70,000 inside of it. That's what you get to put. Now, for the employee, you get to put 23,500 currently. Now, the thing is, Uncle Sam does not care where you put that 23,500, whether you put it in the 401k side, which is pre-tax, or whether you put it in the Roth side, which is after tax. We're able to say between the two of them, I need to have so we have our normal 401k and then we have the Roth. So between the two of them, it needs to total 23,500. That number is set by individual. And so a common question then I'll get is, Dre, what if I have a 401k with my job and a 401k with my business, right? This particular plan, then it needs to total from the employee side, that 23,500. You can't put 23,500 with your employee or your employer and then put 23,000 with your business and put 23,000 with your gig side job. You have to have the money total. And so that ends up being that amount. Now, the magic, of course, comes with the employer amount. So the employer is able to contribute 25%, right? And so there are some nuances that would just take literally a separate video by itself, because you already know the tax code is super weird and complicated, and they're always adding layers without considering the old laws. But a general rule of thumb, 25% of your income. And so what we had, I believe, let me see, make sure my math is good. I believe we had 150,000 and then times 25. Yeah. So if you took my income was $150,000, and then you times that by the 25%, that would equal 37,500. Right. So that means the employer. So you as a business entrepreneur, you have two hats inside of your business. You have your employee hat because you work for your business, but you have the employer hat because you own the business. So you get to contribute to your solo 401k and your Roth 401k from both hats. So you have the employee portion that, as we mentioned, is spread out between all of them, and then you have your employer, 25% of your income. Now, there are caps. I believe it's only $350,000 of your income can be counted towards this. But you're able to say, all right, 25% of my 150,000, that means I'm allowed as the employer to contribute $37,500 to my solo 401k. So that's done on the pre-tax side. And then on the after-tax side, you get to decide. And then that's what we did. We said, well, let's have the employer contribute all of the pre-tax side. And then we had the employee only contribute to the Roth side. And so, boom, now we have the plan put together. You can see that when you're able to use certain instruments and have access to certain vehicles, now all of a sudden you're sitting there thinking, well, the Roth, I make too much, I'm not allowed to contribute, or I can't contribute, it's only $8,000 a year. How is that going to work for retirement? And then you're like, well, have you looked at a Roth solo 401k? Because you can contribute 23,500 to that. And you're like, oh, I didn't know. And then you look at these different options and you get to take advantage of these. And then we'll kind of keep going. Hey, Project Frugal, it says, good day from New Zealand. Yes, sir. What time is it in New Zealand right now? Anyways, what time is it? I do not know. But let me know, and I'll read it, because I'm like, what time is it in New Zealand right now? Thank you for coming, Project Frugal. I appreciate you. Appreciate the support. All right, so high level, that's how your solo 401k works as a business owner. There are other ones. You can have like a set plan as well. And these are for when you don't have any employees. And then there's simple IRAs and simple 401ks when you have employees, but you can only have 100 employees. And then you have the full-blown traditional 401k plan, and they become very, very difficult to set up, kind of expensive to maintain. You can have pensions that you can set up, but again, very difficult to set up. You have to reach out to insurance companies because their actuaries will tell you basically based on life expectancy, how much you have to put each year. If you want to be able to have a little bit of flexibility where you can contribute the amount that makes sense for you as your money ebbs and flows, then this would be the option for you. And that's why we went that route for them. It gives them the most available money. They have up to $70,000 is what they're allowed to contribute, 23,500 as an employee, and then they can put the other 50, or no, we can put the other like 46,500 as the employer. Now, because my income is capped, then I can only really put the 37,500. But once my income goes up, then I can have the rest. And you can see how in a very short amount of time, you can increase significantly how much you have set aside for retirement. And you can make up a lot of lost time really quickly. And that's why it's one of those things that I do enjoy a lot. And so you can see, okay, well, now you know the cap is at 37,500. So we said, all right, let's put $30,000 from the business, the employer, and then you put $10,000 for your Roth. So now you have tax-free income that we're starting to generate. You have some of the pre-tax, so you're able to take advantage of that, take the deductions this year, and then now we can start. Now we can start. I would say allocating your money in a way where it's not just diversifying your money from an investment perspective; it's diversifying your money from a tax perspective. It's diversifying your money from from these required minimum distributions and from all these other different things where we're able to say what makes sense for me based on my income now, what it will be in the future. In a lot of ways, tax-free money, if we're okay paying the taxes today, is a great approach. And so that's why we started putting some money there. And I do believe that will be much more beneficial in the end than putting it in a taxable account, even though we have capital gains, a much more favorable tax rate. But nothing is more favorable than $0 in taxes, right? Nothing's more favorable than that. And so let me show you what that then looks like. So Social Security, we just took it when they retired. So they said they want to retire at 65, take Social Security at 65. The plan works either way, so there's no real reason to make them wait. And let me show you from a tax perspective what that looks like. All right. And so ultimately, when you're putting together the tax strategy, we normally are looking at it from three perspectives. We're talking about the assets that you have in the account. And so with this particular plan, and what we ended up doing is we said, how about we have the allocation pro rata. We have the money that's going into all three, that it goes into our taxable accounts, our tax deductible accounts, our tax-free accounts, and in our tax deductible accounts. So those are the three ways that you normally allocate it. The withdrawal sequence, we're saying, let's take it out of the taxable first. So we're going to have our capital gains first, then we'll have our tax deferred second. So the money that's in our solo 401k, and we'll pay that as normal income. We got to sort of work towards that because we don't necessarily want everything to be there at the end when we have the required minimum distributions. If we're able to spend down our taxable account first, then that's one less thing to worry about. And then we can spend down our tax deferred account, which has required minimum distributions anyways. And then I'm left with my tax-free money. Yay! So at the end of the retirement, all your money isn't being taxed. Then you're like, yes, this is great. And now this particular plan, because of the way their money was allocated and because the business was contributing so much to their overall plan, and we ended up saying, all right, well, let's go ahead and do some Roth conversions from these accounts. And there's a couple ways to do Roth conversions. And all we're basically saying is I have the money in a pre-tax account that has not been taxed yet. And if I'm able to, on certain years where my taxes will be lower than what I'm used to paying, just what I'm normally paying on a regular basis, then I will convert some of my pre-tax account into my normal taxable income. Because now if I'm normally paying 20% every single year, and then something happens where one year I'm at 15%, I'll just do whatever the Roth conversion is to generate 5% more in taxes. So I pay my normal 20%. And the idea is if I have a few $100,000 sitting inside of an account and I don't want to have to pay taxes on it all at once, well, wouldn't you rather spread that out over 10 years, spread that over 15 years? Because it's a much smaller amount. And that's what I would rather do too. I would equate it to almost like Christmas shopping, right? You could buy one or two gifts every single month, and then you'll have a pretty big Christmas. But it doesn't feel as bad, or it doesn't feel as I would say impactful as if you waited in December and you bought all of the same number of presents, but in December, in 1 month, the exact same month. It feels different. The impact is different. And that's sort of how I feel about tax planning or retirement planning, that if we're able to put a plan together where it takes 10 years, 20 years to accomplish, yeah, it's going to take some discipline, but it's much more manageable. We feel a lot better about it because we're doing it over 20 years versus if we have 5 years to make something happen. And so in this particular one, what we said is, we're going to go for a capital gains tax bracket of 15%. And so we have a couple ways we could do it. We could have always done it with ordinary income, where we said, hey, this is what I normally pay in taxes. We could work through that. We could have worked on the Medicare premium tax bracket, where the idea is Medicare doesn't look back and it impacts how much your Medicare premiums are. So we would say, well, I don't want to be in a bracket that pushes me into a new Medicare premium that I pay then the rest of my retirement life, when I could just wait for those 2 years to go by. And then I'm okay, because now I have my Medicare, the number is set, and now I can do the remodeling of my house and all this other stuff. And so that's what that version is. And this particular one, we said it makes sense to just work on the capital gains tax bracket. So that's what we ended up doing, set it at 15%. So anytime we were below that, we did the conversions. And we ended up being able to reduce their tax bill by $536,000. And then we ultimately, or they paid actually $800,000 less in taxes. They had $536,000 more in their accounts as far as the assets. And then they had 2.1 million less withdrawals from tax deferred account, which is a very fancy way of saying we didn't have those required minimum distributions that we would have had. Where Uncle Sam said, you either take the money out of the account, or I'm going to charge you a 25% fee tax on whatever money you should have taken out, which is actually, if that's not crazy enough, that's actually lower than what it used to be. It used to be like 50%. They did lower relatively recently. And so that's nice. So now it's set at that 25% as well. And so we're able to say, okay, based on our goals, what we're trying to accomplish, we're able to put a pretty nice plan together, generate more money, leave $2 million in their account. And when you just make those tweaks on the tax perspective, which started with taking access of a different financial vehicle, all of a sudden we're able to have $2 million more than what we originally had set in our plan, just because we were able to take advantage of options that are already there for us, which I think is actually pretty cool. And so when you're thinking about your retirement plan as a business owner, it's not just about how much money do I set aside, and if I don't know, I just put as much as I possibly can. It's about understanding what you're going to do with the money. It's like, what does my dream retirement look like? How would I enjoy myself? And that's why we're named Obsidian Wisdom, because I do believe the idea of wisdom is, right, you think of King Solomon, and the idea of wisdom was, he was sitting there and he said, all right, I have a kingdom, and he's like, I'm brand new, and I'm kind of worried about being a new king. And he said, all right, God, I know what I want. I want wisdom. I want the ability to know as if I've been on the throne for 100 years. I remember thinking like, yeah, that's like almost like a genie wishing for more wishes, where the genie's like, you get one wish. I said, all right, I want wisdom. Because to me, that's like you're wishing for everything. You get everything with wisdom. And so as a result, Solomon was able to be a pretty spectacular king on the one end, where everybody knew him for all the wise decisions he made. But the biggest thing is we have to hold ourselves to that same standard. And that is often where we mess up. It's called the Solomon's paradox, where he could tell everybody what they should do, and then he was messing up kind of all over the place, because we don't always hold ourselves. We're great coaches to other people, but not to ourselves. So when you're going through a retirement plan, you're a business owner, you're helping people, you're encouraging people, you have a vision, and you know the sacrifice and how long it takes, and you're putting in the grind and getting the results. But then when it comes to your retirement planning, you're like, well, I'll do that later when there's time. But as a business owner, you already know, if you were consulting someone, you would say, no, you can't do it later, because time is your friend or your enemy. It's up to you to decide. And so when you're looking at the retirement plan, and we'll see how that works, if you like this program and just simply want to try it out right yourself, you can go to obsidianwisdom.com/wealthy, and then you can kind of sign up for it, and then you can see what that looks like. And I think I have the ability to show it to you. Yeah, I'm getting better. Can't tell me nothing. All right, so you go to obsidianwisdom.com/wealthy. You can sign up. Naturally, it's not going to be full blown like the one that I have, but it's definitely available to you. If you're someone who just wants to have a conversation and see how you're doing on your retirement plan, whether it's just getting a second opinion, or whether it's just us sitting and talking, and I'm like, hey, these would be the 3 things I would do if I was in your situation, then of course I will also put a link where you can go on my calendar and schedule a little bit of time, and we can have a discussion. I always appreciate the time that you give to me, and I'm thankful for it. If you have any questions, leave them in the comments. I'll use them for the next one if there's any situations you want to see, and I'll continue building retirement plans each week for you. As always, I'm thankful for your time. Stay safe and enjoy life.